Welcome to today's explainer. You know, whenever we look at a company's financial statements, it is so easy to just see a giant wall of numbers. But those numbers, they aren't just randomly generated. They're actually the result of a meticulously crafted structure. So today, we're going to demystify the global language of business and look at the actual blueprint that makes global financial reporting possible, the IFRS Conceptual Framework.
How do we measure the true value of a business? It sounds like a super simple question, right? But to actually answer it, we have to realize that financial reports are built on a foundational framework, a framework that dictates exactly how we spot what's real, what's just an estimate, and honestly, what's missing entirely. I mean, how do we know if a number is a faithful representation of reality? How do we even define what an asset is? Well, that is exactly what this framework resolves. So here's our game plan for today. First, the purpose of the framework. Second, what makes information useful? Third, the elements of financial statements. Fourth, recognition and derecognition. And finally, number 5, how we measure value. Let's dive right in.
Starting off with Section 1, Purpose of the Framework. This is where we build the foundation. Think of this framework as the ultimate shared rulebook of business. Without it, global markets would, quite frankly, be total chaos. Its entire goal is to develop standards that bring real transparency and accountability to financial markets. It creates this single, trusted accounting language that actually lowers the cost of capital and builds trust in the global economy.
But here is a bit of a curveball. Who is this rulebook actually built for? Surprisingly, it is not for management. They already have their own internal data. These rules are specifically designed for the primary users outside the company, the investors, the lenders, the creditors. These are the folks who desperately need to predict future returns and, just as importantly, hold management accountable for how effectively they've stewarded the company's resources.
Moving right along to Section 2, What makes information useful? These are our pillars of quality control. Okay, so for information to be fundamentally useful, it absolutely must have 2 key characteristics: relevance and faithful representation. Relevant information is data that's actually capable of making a difference in your decisions. It has predictive value, confirmatory value, or both. But relevance on its own, not enough. The information also has to faithfully represent the true economic substance of what's going on, not just the legal paperwork. To be perfectly faithful, it really strives to be complete, completely neutral, meaning zero bias, and totally free from error.
Now, to beef up those primary pillars and make them even stronger, the information needs 4 enhancements. Comparability, so you can actually spot trends over time. Verifiability, meaning independent observers could look at it and agree on the math. Timeliness, because stale data is useless data. And finally, understandability. Those standard setters do expect you to have a reasonable baseline knowledge of business to decipher it all. But let's be realistic here for a second. Perfect information is perfectly expensive to produce. Companies spend massive amounts of time and money collecting all this data, and ultimately, it's the users who bear that cost. So the framework enforces a very strict constraint. The benefits of reporting this data must always justify the heavy price tag of producing it. All right, Section 3, Elements of Financial Statements. Time to construct the rooms of our house.
What exactly is an asset? The framework gives it a very precise 3-part definition. First, it's a present economic resource with the potential to produce benefits. Second, it has to be controlled by the entity. And third, and this is absolutely crucial, it must be the result of past events. So it's not just some future hope or dream, it is a real right you control today because of something that already happened. On the flip side, we have liabilities. A liability is a present obligation of the entity to transfer an economic resource as a result of past events. The key phrase to remember here is that an obligation is a duty or responsibility that the company basically has no practical ability to avoid. Whether it's a strict legal contract to pay cash or even a constructive obligation based on a company's past public policies, if you owe a resource to someone else because of a past event, boom, that's a liability.
And that brings us to equity. I love this because the definition of equity is just beautifully simple. It is the residual interest in the assets of the entity after deducting all its liabilities. Basically, it's what is left over for the owners. Think of it as the residual claim on the house once all the mortgages and debts have been fully paid off.
The framework maps these concepts out so perfectly. Your economic resources tie directly to the asset element. Meanwhile, any claims against the entity become either a liability or equity. And as those resources and claims fluctuate day to day due to a company's financial performance, well, that generates your income or expenses.
Interestingly, though, everyday performance isn't the only thing that moves the needle on equity.
Equity also shifts through direct physical interactions with the owners themselves. This includes contributions, like when a company issues new shares, minus distributions, like paying out cash dividends. These specific transactions totally change the economic resources, but they aren't actually classified as financial performance.
Section 4. Recognition and derecognition. Basically, passing the inspection. So how does an item actually pass inspection and get captured on the official balance sheet or income statement? It's a tough club to get into. First, it obviously has to meet the definition of an element, but it also must provide relevant information and a faithful representation. If there is exceptionally high measurement uncertainty, say the range of possible outcomes is just completely wild and unpredictable, recognizing it as a single definitive number might not faithfully represent reality. In those cases, the item fails recognition and might just be disclosed in the footnotes instead.
Then we have derecognition, getting kicked out of the club, so to speak. This is the removal of a recognized asset or liability. For an asset, this normally happens when the company loses control of it, like selling off a warehouse. For a liability, it happens when the entity no longer has a present obligation, like when a massive debt is finally paid off in full. Derecognition ensures the financial statements faithfully represent the new, updated reality of the entity.
Finally, Section 5. How we measure value. The final appraisal. This right here is the great divide in financial reporting. Do we use historical cost or current value? Historical cost relies on the original transaction price, literally what we paid for an asset on day one, updated over time for things like standard depreciation. It is incredibly verifiable. Current value, on the other hand, ignores that original price completely. It updates the value to reflect conditions right now at the current measurement date, giving you a real-time snapshot of worth.
Now, if a standard requires us to use current value, the framework gives us a few different lenses to look through. There's fair value, which is the price you'd get to sell an asset in an orderly transaction in the open market. It's an external, market-driven perspective. Then there is value in use. This one is strictly entity-specific, relying on the present value of the cash the business itself uniquely expects to generate from holding onto it. And lastly, current cost, which just looks at what it would literally cost to acquire an exact equivalent item in the market today. At the end of the day, choosing exactly how to measure value is a massive balancing act for the standard setters. As the framework clearly points out, a highly relevant estimate of future cash flows might unfortunately carry so much measurement uncertainty that it totally fails to faithfully represent reality. Sometimes, historical cost, while it might seem a bit outdated, actually provides a far more verifiable and understandable metric. The choice always circles right back to those fundamental qualitative characteristics we talked about earlier. As we wrap up this explainer on the grammar of business, I'll leave you with this thought. We so often treat financial statements as absolute, objective, black and white truth, but as the conceptual framework reveals, they are actually built on a bedrock of estimates, tricky trade-offs, and very subjective choices about relevance versus uncertainty. So the next time you look at a balance sheet or an income statement, ask yourself, how does the inherent uncertainty in these measurements change the way you personally trust the numbers? Keep that in mind, and you'll be reading financials like a true insider.